Ever dream of earning $17,000 a month without having to show up to a 9-to-5 job? Well, get ready, because today, Liam and I are diving into a secret sauce that can turn that dream into reality. A millionaire dividend portfolio. Imagine your money working so hard for you that you can just sit back, relax, and enjoy the fruits of your investments. Sounds too good to be true. Stick around, because by the end of this video, you, along with Liam, will see how a carefully crafted dividend portfolio can be your golden goose. But here's the big question. How can a regular person like you or me build such a portfolio? Well, stay tuned, because not only are we going to reveal that, but we'll also walk you through the exact steps to get started, the most common mistakes and how to avoid them, and lastly, how much money you need to invest in order to earn $17,000 a month. Trust me, this is one video you won't want to skip. Alright, let's kick things off by understanding the foundation of this strategy: dividends. Imagine you and Liam own a piece of your favorite coffee shop. You don't have to brew the coffee, manage the baristas, or handle the daily grind. But every month, you get a little extra cash in your pocket simply because the shop is doing well. That little bonus is what we call a dividend. Dividends are like a reward companies give to their shareholders just for holding onto their stock. When a company makes a profit, they can choose to share some of that profit with you, the shareholder, in the form of a dividend. It's kind of like getting a piece of the pie just for being at the table. But here's where things get interesting. Dividends aren't just a nice-to-have, they're a powerful tool for growing your wealth. Why? Let's break it down into 3 key reasons. Reason 1, regular income. Dividends provide a steady income stream, almost like getting a paycheck without having to clock in. For many investors, including Liam, this regular income is what makes dividend stocks so attractive. Whether you're looking to supplement your current income or build a reliable source of cash flow for retirement, dividends can be a game changer. Reason 2, stability and reliability. Companies that pay dividends are often well-established and financially stable. They've weathered storms, survived economic downturns, and still managed to make a profit. These aren't fly-by-night operations. They're the bedrock of the economy. Investing in dividend-paying stocks can add a layer of stability to your portfolio, especially when the stock market gets rocky. Liam finds this particularly reassuring. Reason 3, beating inflation. Here's the kicker: dividends can help you beat inflation. We all know that inflation erodes the purchasing power of your money over time. What a dollar buys today isn't the same as what it bought 10 years ago. But companies that pay and increase their dividends consistently can help your investment keep pace with, or even outpace, inflation. In other words, while your savings account might lose value over time, a well-chosen dividend portfolio could grow and help maintain your wealth. But now, you might be wondering, how do I find these golden dividend-paying companies? Great question. Stick with us because next, Liam and I will dive into the exact steps to build a portfolio that could turn your $10,000 into $17,000 per month or even more. $34,000. Yes, you heard it right. Building your millionaire dividend portfolio. Now that we've established what dividends are and why they're so powerful, let's roll up our sleeves and start building your millionaire dividend portfolio. Think of this as assembling a team of superheroes. Each one has unique strengths, but together, they're unstoppable. Step 1. Safety first. Before we go picking stocks, we need to talk about safety. Remember when your parents used to tell you to look both ways before crossing the street? The same principle applies to investing. The best way to avoid risk is to be cautious from the get-go. That means choosing companies with a strong financial foundation, companies that have been around for a long time and have consistently rewarded their shareholders. Let's take IBM as an example. This company has been paying dividends for 28 consecutive years, and not only that, but they've also increased their payout each year. It's like your favorite candy store offering you a bigger treat every time you visit. This kind of consistency is exactly what you want in your portfolio. But IBM isn't alone in this league. We also have Microsoft, Broadcom, American Express, and Apple. These companies have a track record of not just paying dividends but growing them year after year. It's like getting a raise every single year without having to negotiate with your boss. So, how do you pick the right companies? Here's a simple rule of thumb. Look for companies with a solid history of increasing their dividends, a strong balance sheet, and a business model that's built to last. These are the companies that will keep paying you, even when times get tough. Step 2. Diversify, but don't go overboard. Now, let's talk about diversification. Imagine you're hosting a dinner party. Would you serve just one dish? Of course not. You'd want to offer a variety of foods to keep everyone happy. The same goes for your portfolio. Diversification means spreading your investments across different sectors to reduce risk. But here's the thing. There's such a thing as too much of a good thing. Liam agrees that a balanced approach is key. While it's important to diversify, you don't want to overcomplicate your portfolio by adding too many stocks. A good rule of thumb is to hold between 7 to 10 solid companies. This gives you enough variety to reduce risk, but not so much that your portfolio becomes unmanageable. For instance, in our Millionaire Dividend portfolio, we might include IBM for its tech resilience, Microsoft for its innovation, Broadcom for its leadership in semiconductors, and American Express for its financial strength. By selecting companies across different sectors, you're spreading your risk. If one sector has a rough year, your entire portfolio won't take a hit. But don't stop there. Keep in mind the importance of balancing your portfolio. You don't want to put all your eggs in one basket, even if that basket is full of blue-chip stocks. Spread your investments across different industries to cushion against downturns in any one area. Common mistakes and how to avoid them. Alright, you've got your list of companies and your portfolio is looking solid. But let's not get ahead of ourselves. There are still some common pitfalls that can trip up even the savviest investors. Mistake 1. Chasing high yields. One of the biggest mistakes dividend investors make is chasing high yields. It's tempting to go after a stock offering a mouth-watering 10% or 12% yield, but beware. This could be a trap. It's like seeing a flashy car at a great price, only to find out later that it's a lemon. Take Verizon, for example. At first glance, a 7.7% yield might look fantastic, but if you dig deeper, you'll see that the company is weighed down by debt and its profits have been shrinking. This is what we call a value trap. You might get a high yield in the short term, but in the long run, the stock could cut its dividend or even eliminate it altogether. Liam is now cautious about chasing these flashy numbers. Another example is Barnes & Noble. With a dividend yield over 9%, it might seem like a goldmine. But the company has been struggling to keep up with competition, and its sales have been declining for years. High yield often comes with high risk, and it's essential to look beyond the yield to see if the company's fundamentals are strong. Mistake 2. Not reinvesting dividends. Another common mistake is not reinvesting dividends. Imagine you've planted a tree that gives you fruit every year. Instead of planting the seeds from that fruit to grow more trees, you just eat the fruit and move on. Reinvesting your dividends is like planting those seeds. It's how you grow your wealth over time. Liam is learning the importance of reinvestment to maximize returns. Let's take a simple example. Suppose you invest $10,000 in a stock with a 10% dividend yield. If you just collect the dividends and spend them, you'll earn $1,000 a year. Not bad, right? But if you reinvest those dividends, your $10,000 could grow to nearly $200,000 in 30 years, paying you over $18,000 a year in dividends. That's the power of compounding, and it's how you turn a modest investment into a substantial income stream. Mistake 3. Overlooking the payout ratio. The payout ratio is another crucial metric that many investors overlook. The payout ratio is the percentage of a company's earnings that are paid out as dividends. Ideally, you want to look for companies with a payout ratio of 60% or less. This gives the company room to grow and continue paying dividends even during tough times. If a company's payout ratio is too high, say 80% or 90%, it means they're paying out most of their earnings as dividends, leaving little room for reinvestment in the business. This can be risky because if the company's earnings take a hit, they might have to cut their dividend. The dividend snowball effect. Now, let's dive into one of the most exciting aspects of dividend investing, the snowball effect. Imagine you're rolling a small snowball down a hill. As it rolls, it picks up more snow, getting bigger and bigger. That's exactly what happens when you reinvest your dividends. Liam loves this concept. It's like watching your money grow on autopilot. The idea here is simple. The more dividends you earn, the more shares you can buy. And the more shares you own, the more dividends you earn. Over time, this creates a compounding effect that can significantly boost your portfolio's value. Let's take another look at that $10,000 investment we mentioned earlier. Without reinvesting dividends, you'd earn $1,000 a year. But if you reinvest those dividends, your investment could grow to nearly $200,000 in 30 years. The kicker? That $200,000 investment would then pay you over $18,000 a year in dividends. That's the snowball effect in action. Liam is excited to see how this could work for him. But what if you can't invest $10,000 up front? No problem. Even smaller, consistent investments can have a powerful compounding effect over time. For example, if you start with just $1,000 and invest an additional $200 every month, reinvesting your dividends along the way, you could still end up with a substantial portfolio that generates a steady stream of income. How much to invest? Now, let's get to the big question on everyone's mind. How much do you need to invest to live off dividends? The answer depends on your financial goals, but let's explore a few scenarios to give you a clear picture. Imagine you have a 30-year investment plan where you decide to reinvest the dividends back into the same stocks that paid them. For instance, IBM has a 10-year dividend growth rate of 7.05%, Microsoft at 11.57%, Broadcom at 37.71%, American Express at 10.44%, and Apple at 9%. Church & Dwight shows a growth rate of 7.48%, Expeditors International at 8.9%, Ecolab at 8.96%, Brown & Brown at 9.69%, and NextEra Energy at 10%. If you add all these growth rates together and divide by 10, the number of stocks in your portfolio, you'll find that the average dividend growth rate of your portfolio is 12.19%. Based on these numbers we have. Scenario 1. $10,000 investment. Let's say you start with a $10,000 investment in our Millionaire Dividend portfolio mentioned above. If you reinvest your dividends and give it 30 years to grow, your portfolio could balloon to over $350,000, paying you nearly $3,500 a month in dividends. That's enough to cover many living expenses and enjoy a comfortable lifestyle. Liam finds this very encouraging as a starting point. Scenario 2. $50,000 investment. If you can invest $50,000 up front, your portfolio could grow to over $1.8 million in 30 years, generating over $17,000 a month in dividends. This is where things start to get really exciting. You could live luxuriously, travel the world, and never worry about running out of money. Scenario 3. $100,000 investment. For those with a larger budget, a $100,000 investment could grow to over $3.6 million in 30 years, paying you a whopping $34,000 a month in dividends. This isn't just financial security, this is financial freedom. With $34,000 a month, you could live your dream lifestyle, whether that means buying your dream home, traveling the world, or simply enjoying the peace of mind that comes with knowing you'll never have to worry about money again. But what if you can't start with $10,000, $50,000, or $100,000? Don't worry. Even if you start small, the key is consistency. By regularly investing even modest amounts and reinvesting your dividends, you can still build a substantial portfolio over time. And remember, it's not just about how much you start with. It's about making smart, informed decisions and being patient. Liam is committed to starting his own journey, no matter the amount. So, there you have it. Building a millionaire dividend portfolio that could pay you $17,000 a month isn't just a pipe dream. It's entirely possible with the right strategy. Start with solid, reliable companies, reinvest your dividends, diversify wisely, and most importantly, give your investments time to grow. The magic of compounding will do the heavy lifting, turning your initial investment into a powerful income-generating machine. Liam and I are excited to see where this journey will take you. And remember, it's not about how much you start with. It's about making smart, informed decisions and being patient. Whether you're starting with $1,000 or $100,000, the key is to start now and stay committed to your strategy. Ready to start building your millionaire dividend portfolio? Hit that subscribe button because we've got more tips and tricks coming your way. And don't forget to check out our other videos where we dive deeper into dividend investing strategies. Make sure you watch the video on your screen right now. Liam will be there learning alongside you. Take care and see you next week.